Today we're doing a complete breakdown of ASC 250. We'll cover the scope, core principles, measurement, journal entries, and real interview questions. Whether you're studying ASC, prepping for a Big Four interview, or working in finance, this is everything you need to know. Imagine discovering a $2 million error in your company's financials. Before ASC 250, correcting such errors meant inconsistent reporting and potential financial chaos. Understanding ASC 250 means knowing how it brought order by standardizing corrections and changes. This section reveals its impact on accuracy and transparency in financial reporting. ASC 250 emerged to standardize the reporting of accounting changes and error corrections. Before its existence, financial statements varied widely in approach, making comparisons difficult. This standard ensures consistency by mandating retrospective application for principal changes and corrections. When an error is found, ASC 250 guides accurate restatement, enhancing reliability in financial data. ASC 250 is relevant to any entity reporting under U.S. Generally Accepted Accounting Principles, effective from December 15, 2008. Its most crucial requirement is the retrospective application for changes in accounting principles and error corrections. This ensures transparent and comparable financial statements. Disclosures must explain the nature and rationale behind changes, reinforcing trust in financial reporting's integrity. The core model for accounting changes under ASC 250 is pivotal for ensuring financial consistency. It mandates retrospective application, meaning prior periods are restated for clarity. This approach, coupled with disclosure requirements, allows users to grasp the change's effects. Understanding this model is crucial for interviews, showcasing your grasp on maintaining consistent, reliable financial statements. Scope is crucial, as it defines the boundaries of ASC 250. Many overlook that changes not affecting financial statements are excluded, a classic interview trap. Understanding what's included and excluded can dramatically impact how one reports financial results, especially when making accounting changes or correcting errors. ASC 250 addresses changes in accounting principles, estimates, and error corrections. If a company changes from FIFO to LIFO, it must comply with this standard. Similarly, changing an asset's useful life affects depreciation and must be documented. Errors like misstated revenue require correction under ASC 250 to ensure accurate financial statements. ASC 250 excludes minor changes that don't affect financial statements. For instance, a policy update that doesn't alter reported figures isn't covered. Routine, immaterial changes like minor policy tweaks don't fall under this scope. Interviewers often test candidates on these exclusions, knowing they are common pitfalls for those not fully versed in ASC 250. An accounting change encompasses shifts in principles, estimates, or error corrections. Suppose a company switches from average cost to FIFO. This change requires careful documentation under ASC 250. Similarly, if an asset's useful life is revised, or an error like overstated expenses is fixed, these are treated as accounting changes. Understanding these nuances is key to accurate financial reporting. Retrospective application involves restating financials to align with new principles as if they were always in place. Imagine adopting a new revenue recognition method. Past statements need restatement under ASC 250. This ensures consistency and comparability over time. Retrospective adjustments may require recalculating previous periods' assets and liabilities, offering a complete view of financial changes. Imagine discovering a non-material error post-financial statement issuance. ASC 250 scope doesn't require restatement for immaterial changes. Routine updates to policy manuals don't trigger ASC 250 either. However, significant errors or adopting a material new policy do. Interviewers often challenge candidates with these gray areas, assessing their depth of understanding in applying ASC 250 correctly. Imagine a company suddenly needs to report an accounting change due to a new contract. The core model for accounting changes ensures these shifts are handled consistently, keeping financial reports reliable. This model is essential for maintaining transparency and investor trust. The core model for accounting changes provides a structured method for handling changes. With Meridian Corporation's $10 million SaaS contract, We'll explore each step, ensuring that the $8 million software and $2 million services are accounted for correctly. This model ensures all changes are consistent and transparent, crucial for stakeholders. Meridian Corporation must first decide if recognizing its $8 million software separately from $2 million services in the SaaS contract involves a policy or estimate change. Misclassification here could lead to significant reporting errors. ASC emphasizes precise classification to ensure proper accounting treatment. This decision sets the foundation for the next steps, guiding the company's financial reporting adjustments. Building on Step 1, Meridian Corporation now decides how to retrospectively apply changes in recognizing the $8 million software. Choosing the wrong method could mislead stakeholders, affecting trust. ASC typically requires retrospective adjustments for policy changes, unless impractical. This choice impacts how previous financial statements are restated and provides consistency across fiscal periods. Meridian Corporation must now assess how the retrospective recognition of its $8 million software alters its financial statements. Missing cumulative effect calculations could cause severe discrepancies. ASC mandates thorough analysis of all financial impacts, ensuring adjustments are accurately reflected. This step is critical for providing an accurate historical comparison and maintaining financial integrity. Having assessed the impact, Meridian Corporation must now disclose this $8 million software recognition in its financial notes. Failing to detail these changes could mislead investors and analysts. ASC emphasizes transparency, requiring full disclosure of changes and their effects. Proper disclosure clarifies past performance adjustments and aids in informed decision-making for stakeholders. The final step sees Meridian Corporation implementing the $8 million software recognition in its accounting systems, ensuring seamless integration into future financial operations. Skipping system updates risks ongoing discrepancies. ASC mandates that all changes are fully reflected in accounting records, securing accuracy in ongoing and forthcoming financial reporting. This step solidifies the transition and ensures continued compliance. The measurement method you choose directly impacts your balance sheet. A wrong choice can overstate assets by millions. ASC 250 guides these choices and mandates specific disclosures to ensure transparency. Understanding these requirements helps finance teams present truthful financial positions to stakeholders, preventing costly errors and potential regulatory issues. When a company changes an accounting principle under ASC 250, it recognizes this change at the start of the earliest period presented. If retrospective application isn't feasible, measure cumulative effects at the date of change. For example, if a new standard affects revenue recognition, adjustments might alter prior year revenues on financial statements. Once an accounting principle is changed, subsequent measurement under ASC 250 mandates consistency. Changes affect only current and future periods unless impractical. If additional guidance emerges or errors are found, remeasurement might be needed. For instance, a revised estimate affects only the current and upcoming periods, not past financials. ASC 250 demands precise presentation in financial statements when changes occur. Adjustments often impact line items like retained earnings or income tax. Notes must clarify the change's nature and rationale. Consistency is key, with adjustments shown in comparative financials to maintain transparency. For instance, a change impacting revenue recognition will be detailed in financial notes. ASC 250 mandates several key disclosures. Justifying the change as preferable is crucial for stakeholder trust. Detailing the method used aids in understanding financial outcomes. Prior period adjustments give historical context, while disclosure of impacts on line items ensures transparency. This level of detail ensures users of financial statements appreciate the full implications of the changes. Imagine a CFO facing a new revenue recognition standard, needing to adjust $2 million in deferred revenue. If retrospective application is impractical, the cumulative effect is recognized in the current period. Adjustments appear in retained earnings, with detailed notes explaining these changes. Open communication with stakeholders ensures everyone understands the impacts and future consistency in reporting. Meridian Corporation, a global manufacturing company, enters into a significant change in accounting estimate. discover how this affects their financials through a real-world scenario. We'll follow their journey as they reassess a major asset on their balance sheet, impacting their bottom line. Recording the initial acquisition of the machinery at its purchase cost is essential for accurate asset valuation. ASC 250 mandates recognizing tangible assets at their historical cost. By doing so, Meridian Corporation ensures that their balance sheet reflects the true value of their newly acquired equipment, setting a clear baseline for future depreciation and adjustments. Depreciation allocates the cost of a tangible asset over its useful life. Meridian Corporation charges $240,000 annually, reflecting the machinery's wear and tear. ASC 250 ensures that expenses match revenue generation from assets, providing a more accurate depiction of profitability and asset lifespan on financial statements. Revising the useful life of an asset affects future depreciation expenses. ASC 250 requires changes in accounting estimates to be accounted for prospectively. For Meridian Corporation, this adjustment acknowledges improved efficiency or maintenance, thus extending the machinery's productive life, impacting current and future profitability. Recognizing an impairment loss adjusts the asset's book value to its recoverable amount when it falls below the carrying amount. ASC 250 requires this to prevent overstating assets, ensuring Meridian Corporation's balance sheet reflects true economic realities, safeguarding investors' understanding of the company's financial health. Reversing impairment loss increases the asset's carrying amount, aligning it with its recoverable amount, as per ASC 250. This entry reflects better market conditions, improving investors' confidence in Meridian Corporation's asset utilization and financial prospects, ensuring transparent reporting of asset valuation changes. Disposing of an asset at its book value results in no gain or loss on disposal, a straightforward accounting event. ASC 250 ensures that accumulated depreciation offsets the asset's cost entirely. Meridian Corporation's financial statements reflect this disposal cleanly, eliminating the asset and its related accounts from the books. Changing accounting policies often requires retrospective adjustments to maintain consistency in financial reporting. ASC 250 mandates adjusting prior periods' financials, ensuring comparability over time. For Meridian Corporation, this reinforces transparency and accuracy, offering stakeholders a clear view of how policy changes impact reported earnings and asset values. Every Big Four and investment bank interview on ASC 250 follows a pattern. Here are the 10 questions that come up again and again, with answers that will make your interviewer nod. ASC 250 governs accounting changes and error corrections. It ensures consistency and comparability in financial statements over time. The standard requires retrospective application for changes in accounting principles, helping users understand historical trends. A common mistake is confusing it with prospective application methods. Candidates should remember, retrospective ensures clarity. Error corrections are crucial for maintaining the integrity of financial statements. ASC 250 ensures that errors are rectified to reflect accurate financial performance. This process involves restating prior periods, which provides stakeholders with reliable data. The trap here is failing to disclose impacts on financial statements. Key takeaway: transparency is non-negotiable. A change in accounting principle involves switching from one generally accepted accounting principles method to another, requiring retrospective application. A change in estimate, like depreciation life, is accounted for prospectively. Knowing the distinction is vital. Confusing these can lead to incorrect financial reporting. Memorize: principles change past, estimates change future. Retrospective application requires restating prior financial statements as if the new principle had always been used. For instance, change in inventory valuation from FIFO to LIFO necessitates recalculating past year's cost of goods sold. The trap is ignoring the disclosure of impacts. Remember, restate past, disclose impact. Changes in accounting estimates, like revising the useful life of an asset, impact current and future financial statements. For example, reducing a machine's useful life from 10 to 8 years affects depreciation expense moving forward. The mistake? Treating it like a principal change. Key: estimates alter future. Indian accounting standard aligns closely with international financial reporting standards, but allows more guidance on certain disclosures like error corrections. A notable difference is the treatment of non-mandatory disclosures, where Indian accounting standard can require more detail. Trap, assuming no differences exist. Remember, subtle nuances matter in global standards. Under international financial reporting standards, error corrections require retrospective restatement, while US generally accepted accounting principles also mandates restatement, but allows exceptions for impracticality. This can lead to different impacts on comparability and transparency. Candidates often overlook exceptions in generally accepted accounting principles. Key point: know when exceptions apply. ASC 250 doesn't cover changes in reporting entities or transactions that are not errors. This exclusion often leads candidates to incorrectly apply ASC 250 guidance. Understanding the scope prevents misapplication. Memorize: not every change falls under ASC 250, especially organizational or transaction-related changes. Under ASC 250, a CFO must disclose the nature of the change, reasons for the new method, and its impact on financial statements. This ensures stakeholders understand the change's rationale and effects. A common error is omitting comparative data. Remember, disclosure is about clarity and accountability. Determining if a change is a principal shift or an error correction involves assessing whether the initial accounting was generally accepted accounting principles compliant. Principal changes are voluntary and systematic, while errors are compliance failures needing correction. The trap: misidentifying voluntary changes as errors. Key insight: intent and compliance dictate classification. Grasping ASC 250 starts with understanding its goal: consistency and comparability in financial reporting. The standard applies broadly to all entities, covering changes in principles, estimates, and reporting entities. Retrospective application is often needed for principal changes. Estimate changes are treated prospectively, reflecting current conditions. Reporting entity changes require restatement of prior periods. Full disclosure of the nature, reason, and impact of changes is essential. The heart of ASC 250 lies in its core model, categorizing changes into principles, estimates, and reporting entities. Principal changes usually need retrospective application, unless impractical. Estimate changes affect future statements, adopted prospectively. Reporting entity alterations demand restated prior periods. Measurement rules dictate that principal changes affect all periods shown, while estimate changes impact future periods only. Essential disclosures involve the change's effect on financials. When preparing for interviews, know that failing to disclose change impacts can be a major compliance pitfall. Understand the distinction between principal and estimate changes, as their treatments differ. Retrospective application challenges often hinge on proving impracticality. ASC 250's approach to retrospective application contrasts with IAS 8. Disclosures must be clear about the change's nature and reason. Practical expedience can sometimes ease retrospective burdens, ensuring comparability remains paramount. That's your complete guide to this accounting standard. If this video helped you, please like and share. It genuinely helps us keep creating content like this. Drop your standard requests in the comments. Subscribe to Candy Mentor for more accounting and finance videos. We'll see you in the next one.